Using your home equity to buy your next home is something that's been around for some time but wasn't that common. But over the last few years, with skyrocketing home values, there was an increase of savvy home sellers that leveraged this to their advantage. And by using this strategy, they're building long-term wealth and being more competitive when it comes to competing against multiple offers. Now, say you've been in your home for 4 to 6 years or more and you've outgrown it, or you've decided to combine households with an aging parent. The thought of selling a property and buying another at the same time can be overwhelming. And at the same time, you're also looking at the future. You want to build wealth. You want to set yourself up so that you can maybe even retire early. Well, the way to do that is to pull the equity out of your home so that you don't have to sell that house right away, and then use that equity as a down payment on your next home. And then after you buy that next home, you can turn around and take your first property and rent it and create a steady cash flow that will pay off the mortgage and build you a nest egg for the future. I'm going to go over how this works, but first we're going to dig into home equity. So home equity is essentially your current market value minus what you owe on the house. Outstanding mortgages, any liens that you have on the property. So the first step is to figure out what the current market value is. Now, what you don't want to do is go to the online resources, the Zillows and the Redfins, those automated websites that have never been in your house, because they don't take into consideration the repairs, the updates, the curb appeal, the local neighborhood conditions, all the things that affect what a buyer would be willing to pay for your particular home. So the best way to get an accurate number would be to call your local agent. Now, if you have a relationship with the agent that sold you the house, great. They don't even have to come out to the house. They can just put a number together. You can let them know what you're doing, and they can give you a ballpark number of where you would be so you can start figuring out what that equity is. Another option would be to talk to the lender that's doing the equity loan. Sometimes these lenders have automated systems that will give you a reliable number to base that equity loan on. And the third option would be to hire an appraiser. And an appraiser does cost money, whereas a real estate agent should do a valuation for free. But it is possible that the equity loan bank, the lender that's doing your equity loan, might accept that appraisal as part of their process, so you don't have to pay for it twice. Now, say your current market value is $500,000 and you owe in mortgages $300,000. That gives you an equity of $200,000. However, you cannot borrow the entire $200,000 from the bank. The banks won't give you 100%. They won't mortgage 100% of the market value. Typically, they will only give you 80% of that equity. So out of that $200,000 equity, you're looking at a loan potential cap of about $160,000. Now, what can this $160,000 be used for? You can use it for down payment on the next house. You can use it for closing costs. You can use it to pay down debt. And say you have some student loans that you want to pay off before you get into the next house. Maybe you have some home renovations that you want to pay off. You can use that money towards those purchases up to $160,000. Now, you have several financing options for tapping into this equity. The first would be your traditional home equity loan. It is given to you in a lump sum. You have to predetermine what that amount is. You have to tell the bank, I would like $160,000, I would like $150,000. They will write the note on that $150,000 and you will get it as a lump sum. Now, keep in mind, going into your second house, if you decide to keep the first house, that first mortgage remains untouched. So you have your first mortgage, maybe you were able to refinance, you have a low interest rate, you can keep that mortgage at that low interest rate, and then you have your equity loan on top of that mortgage. Now, the payments are going to be fixed. It is a set amount of money and a set payment over the period of anywhere between 5 and 20 years. Now, the common max LTV, which is the amount of money, if you have that $200,000, how much of that $200,000 can you borrow? In a home equity loan, typically it's about 85%. Again, the home equity loan, you have to decide ahead of time exactly how much money you want to pull out. Now, a second option would be a HELOC, or a home equity line of credit. HELOCs are like credit cards on your home equity. The max HELOC amount, say $160,000, is set, but the line of credit starts at $0. Your payments are on what you spend. If you only spend $40,000, $50,000 of that line of credit, your payments are only going to be based on that $40,000 or $50,000. Now, the interest rates on HELOCs, a lot of them do float because you can have a HELOC for 5 or 10 years, never use it. Some people use HELOCs as an emergency fund or a reserve fund. And if you never spend any money, it just sits there. It doesn't cost you anything, but the interest rate does fluctuate. And the max you can take out is going to be 80 to 85%, depending on the loan program. Now, the third option would be a cash out refinance. Now, this would be if you had a higher interest rate mortgage and you wanted to refinance down to a lower interest rate mortgage, at the same time, pull cash out of the equity that you have. Again, the max loan to value is going to be 80% of what you can pull out. It is going to be a set lump sum of money. But the big difference is that this is not going to be treated as a separate loan. It gets combined with your refinance on your existing mortgage and the new cash that you just pulled out of the equity into one loan payment. Now, real estate is local, and if you're thinking about making a move, you want information about your community, your town. Now, I've been in the business for over 25 years. I have built relationships with the top agents in the country, coast to coast, and I can connect you with one of those agents that will take great care of you. Just click the link down below. There will be no sales call, but I will get back to you within 24 hours, and I'll connect you with one of the best agents in the country that will give you the most updated information and will take great care of you. Now, there's a lot of positive reasons why you should tap into your equity, and one of them is that it unlocks opportunity to build your financial portfolio. If you were to take that equity from the current home, buy a second home, and then turn that first home into a rental, now you're having cash flow, positive cash flow that will pay down that mortgage, and now you have a nest egg that you can use for the future, sell that down the road closer to retirement that you wouldn't have if you just sold the property and took all that equity and put it in the next house. And by doing so, you can take advantage of rising home values. Over the last 50 years, home values have gone up, they've gone down, but over a course of 50 years, they have steadily risen. Prices will never be what they were in the 1960s and 1970s. They will always continue to slowly rise. So if you hold on to that property for the long term as a rental, down the road, it will be worth more than if you sold it today. And lastly, you get to hang on to that low interest rate on the first home. That property, if you don't sell it, turn it into a rental, as that's getting paid down, that is locked in at the 2.5%, 3.5% interest rate that you were able to refinance at over the lifetime of the loan. Now, there definitely are some drawbacks to tapping into the equity this way. And the first is on the first property, because you're pulling out all that equity, and you go to sell that property. If you decide that rentals are not your thing, or you need to consolidate and to sell that property, now your equity has been diminished. You're not going to get that much from that property immediately. Over time, as that equity builds back up, but in the immediate future, that equity is going to be tapped out. You're not going to have anything to tap into in the case of an emergency. The other drawback is that it decreases your buying power. You have that first mortgage stays with you. Now you tap on the HELOC. So now you have two mortgages going into buying your next home. That will decrease the amount of home you can buy if you didn't sell that first mortgage. And keep in mind that the amount that you can purchase on the next property is going to be determined by what you can afford. And if you are still carrying that first mortgage, it is going to potentially decrease. Now, there are some ways around that, and we'll talk about that in a minute, but just know that it does affect your buying power on the next purchase because you do have that existing debt that you're not going to be canceling out. And the last drawback is the debt. You are going to be coming out of this with not one mortgage, but 3 mortgages. The first mortgage, your HELOC, and then your new mortgage on the new property. So now you might be thinking, I can't afford 3 mortgages. How am I going to do that? Well, the answer is to turn your primary residence into a rental. After you purchase your second property, you've moved into that property, now you turn that first property into a rental, and that rental income will help cover that first mortgage. Now, the lending rules for using rental income has changed over the years. It used to be that you had to have a rental history, a 6-month or 12-month history of receiving that rental income in order to use it to qualify for your next mortgage. But those requirements have changed, and a lot of lenders are allowing homeowners to use that future income from that rental, as long as you can prove that it is a competitive rent, that you have a lease signed for the new tenant, you have a tenant in place, someone who is ready to go, who will sign a lease for at least a year, a guaranteed promise to pay, a promise to rent. You can show that to the lender, and the lender will use that as income to help you qualify for that next mortgage. Now, there are some upsides and downsides to turning your primary residence into a rental. The first upside, as I just mentioned, is that you can use that rental income to help qualify for your next mortgage. And by doing so, you're paying down that first mortgage. Another upside is the potential for positive cash flow. If, for example, you have an outstanding mortgage of $1,500 on that first property and you're able to rent it for $1,700 a month, you'll have a monthly positive cash flow of $200 a month. And then lastly, there are tax advantages to being a landlord. There's a number of tax credits that you can claim on your tax return that will help you save money around tax time. Things like repairs, maintenance, cleaning, if you end up having to hire a management company to help offset some of these things depending on where the rental property is located. If you end up moving to another state and you hire a management company to help manage that property, all of those fees could potentially be tax deductible, which will actually put money back in your pocket. Now, unfortunately, being a landlord also has its drawbacks. And one of those drawbacks is dealing with repairs. Sometimes things happen and they're unexpected, like having a car drive through the side of your house. A friend where this happened. In the middle of the night, a car went off the road, went through the front of her property that she rents out, and thankfully the tenants were not hurt, the driver was not hurt. However, the house didn't fare very well, and so having to deal with going over there in the middle of the night, having to deal with insurance companies, having to deal with tenants. Hopefully the tenants have renter's insurance. That would be something you would definitely want to put in your lease to require tenants to have renter insurance, because you as the landlord are not responsible for all their stuff. If their stuff gets damaged, that's on them. But you don't want to have that battle, after the fact if the tenants don't have renter's insurance. So these are the types of things that you'd have to potentially deal with. There's also the drawback of having to deal with tenants themselves. You go through the process of vetting out a tenant, make sure that you call the previous landlords that they've rented from, and background checks and credit checks and all the things that you're allowed to legally do, but it can still backfire. If a tenant gets laid off, they very well may decide that their landlord is going to be the last one on the list to get a check that month. So those types of situations, which is why it's a good idea if you have positive cash flow, put that in a separate account. Make sure that you have a good buffer for those times where you might have to cover that first mortgage on your own because you had a gap in the tenants. But having to be able to navigate that and go with the flow, so to speak, to, when you do have those types of situations is crucial. So you've gone through the process, you've done your current market value, you've talked to a lender, you know how much money you can pull out for a down payment on the next house. Now the question is how do we turn your first property into a rental? Now, the first thing you want to do, you want to check with your mortgage company to see if there are any restrictions on you renting out your home. Most mortgage companies will not have a problem. It's usually within the first 6 months to a year. If you get a conventional 30-year fixed mortgage and you sign the paperwork at closing saying that you're using this property as a primary residence, they're not going to like you turning that into a rental after 6 months. But we're talking 4 years, 5 years, 6 years down the line or more. Chances are there are not going to be any requirements on your mortgage that will prevent you from turning that into a rental, but you want to check that just in case. The next step is letting go of the emotional attachment you have with your home. You want to turn your home into a house for rent. And if this was your first house, that's not an easy process to go through for a lot of people. You may have poured your blood, sweat, and tears into this house, doing repairs and upgrades and all the little things that no one's really going to appreciate except for you. And you need to have a mindset of this is a business transaction. The renters are going to come in and they may scratch the floor, stain the carpet. They may put marks on the walls. It just is. And these are just repairs that'll have to be done after the renters move out, but it's separation of, okay, that's no longer my home, it's just a house. And that's something that I think mentally a new landlord needs to get, prepared for so that you can start planning for that. Planning, make sure you have money in those reserves, take some of that equity that you pulled out, put it aside, put it in reserves for those repairs that may need to be, had down the road. But just that emotional detachment so you can make sure that you go into this from a business mindset for the right decisions. Now, the next step is to check your local rental market. Now, across the country, the rental market has been just exploding. Low rent availability, high rents, high demand. However, you want to make sure that you are in tune with what's happening with your local market. I would reach out to your real estate agent. If you have a relationship with a local agent, lean into that. Find out what they're seeing in the local rental market, and then start doing some homework to find out, okay, what would my house rent for? So you can add an idea when you're putting your budget together if this is something that will even cover the mortgage. You want to make sure that that mortgage amount is covered. What you don't want is a negative cash flow. If you have a $2,000 a month mortgage payment, you want to make sure that you get at least $2,000 a month in a rent so that you can break even on that mortgage payment. So check your local market, get a feel for what the rents are, how much demand there is, because the other thing to take into consideration is if you're relying on rental income to cover that mortgage and the market is all of a sudden starting to turn and there's a lack of renters, you don't want to be in a situation where now you're carrying two mortgages and now you're starting to struggle because that first mortgage isn't being covered. And then lastly, depending on where you live, you may want to look into an Airbnb or a seasonal rental versus a year-round rental. This will tie into that market research, finding out what is being rented, what the average rents are, how long the renters are staying for. If you're in an area, a beach community, waterfront community, an area where it sees regular seasonal renters, you actually might be able to cover your mortgage in the course of 6 months for the entire year by doing a seasonal rental as opposed to a year-round rental. So you want to look at all those different options to see financially what it is that what avenue you want to go down. This might be something, if you have a beach property or something that has a real scenic, element to it, you could only rent it for 6 months out of the year, use it yourself 6 months out of the year, and then at the same time, you're having that mortgage covered in full out of that seasonal rent. So it's something that you want to look into, do your homework on, and kind of weigh out depending on your area. Using home equity this way is a great opportunity to help build that generational wealth, that future wealth, help insulate you against any potential future economic downturns. But it starts with your current market value. And if you want 5 ways to help build that market value, increase that market value by doing some repairs and improvements around your home, check out this video. I'm Jen Sylvester, and I want to help you become a savvy home seller.